Good morning, everyone, and welcome to the 2023 year-end tax planning for individuals and families. I want to kick this off with starting out some housekeeping items for everyone. Your CPE certification. You need to make sure you know that this is a 1-hour credit. So for 50 minutes, we'll talk taxes, technical field of study. There's no partial CPE credit offered for this event. Please log in with your unique link and stay logged in for the entire webinar in order to ensure that you receive your CPE credit. Also, in order to ensure that you get CPE credit, make sure you answer 80% of the polling questions. I would suggest answering all the polling questions just in case there's a technical glitch, but 80% must be answered in order to receive CPE credit. The answer does not have to be correct, but it just has to be answered. Certificates will be distributed via email within 7 days of this event, and email certificates will be delivered from Carr, Riggs, and Ingram. So it'll be at support@herlera.com. Questions about the certification process can be sent to marketing@cricpa.com. And there will be presentation slides accessible for download in the chat throughout this Zoom webinar. All right, so my name is Tina Stewart. I am a partner with Professional Services. I have a master's from LSU. I love CrossFit. I have a dog named Peanut, and I recently went and did rim to rim on the Grand Canyon. I am joined by your presenter, Stephanie Spinucci. She's also a partner in our tax practice. She has her master's from the University of South Alabama. She likes running and completing 10Ks and 3 half marathons, and she likes traveling anywhere warm and tropical. And it looks like she has a cute little English Springer Spaniel named Lulu as well. We are also joined by Tom Monte. He is another one of our tax partners from Barton College. He likes watching North Carolina State athletics, spending time on the river at the beach, and he has a miniature schnauzer named Bella. And with that, I am going to go ahead and hand this over to them to start with their agenda.
Thank you, everyone, for taking the time out of your day to join our webinar. Here's our agenda for the day. Tom and I are going to tag team this. We're going to start out with the 2023 updates to the tax brackets and deductions. So the U.S. uses a marginal tax system, which means you're not taxed on your income, which means you're taxed on your income in stages or brackets. There's a common misconception that all of your income is taxed at the highest bracket you fall in, but that's just not true. Timmy, can you go to the next slide? To find your set of brackets, you first need to determine your filing status. Are you filing a single, unmarried taxpayer, married filing joint, married filing separate, or head of household? The brackets for each can be found on this slide and the next slide. For married taxpayers, in most cases, filing jointly is going to be more beneficial than filing separately. Running both scenarios is the only way to know which provides the greatest benefit or the least amount of tax. And our tax preparation software can run that analysis for you. These tax brackets are adjusted annually for inflation. All right, next slide. All right, standard deduction and itemized deductions. Now let's take a look at the various deductions which will reduce your taxable income. Each taxpayer is eligible for a standard deduction that varies based on your filing status. You have the option of taking the standard deduction or itemizing your deductions. In most instances, you only take the itemized deduction if it exceeds the standard deduction you're eligible for. Itemized deductions include expenses such as your unreimbursed medical and dental expenses, state and local income tax, general sales tax, real estate taxes, personal property taxes, your home mortgage interest, investment interest, and your charitable donations. Each of these have limitations, which we'll discuss. The married filing joint standard deduction for 2023 is $27,700. That amount is halved if you're filing as single or married filing separately. Head of household is eligible for a $20,800 standard deduction. The base standard deductions also increase each year for inflation. To file as head of household, you must be considered unmarried on the last day of the year and have a qualifying child or dependent. The standard deductions allowed are increased by each elderly and or blind taxpayer. For example, the the standard deduction in 2023 for a married filing joint couple in which both are elderly and one is blind is eligible for a $32,200 standard deduction. In this scenario, you take the base standard deduction of $27,700 and add $1,500 3 times, once for each elderly and once for blind. All right, let's talk about medical expenses. For medical expenses to be included in your itemized deductions, the out-of-pocket cost must exceed 7.5% of your adjusted gross income, and only the excess amount is included as a deduction. For example, if your AGI is $100,000, only the out-of-pocket medical cost exceeding $7,500 can be included with your itemized deductions. For tax year 2023, the medical mileage deduction has a rate of 22 cents a mile. Sufficient records should be kept to support any medical mileage deduction claimed. You may be able to claim a higher medical expense deduction in years in which you have lower income. If you're able to plan out certain medical procedures in years with lower income, you will get a greater benefit for the medical expense deduction because of the 7.5% floor will be lower. Long-term care insurance is also included as a medical expense deduction, but the max deduction for the premium is based on your age. So if you're 40 years old or younger, your max deduction is $480, and then that increases incrementally with your age. So all the way up to age 71 and older, you can deduct up to $5,960 of your long-term care insurance premiums. The provision for long-term care insurance is becoming very significant as part of any retirement plan, just as our population ages. All right, itemized deductions, taxes, and mortgage. So as a refresher, the Tax Cuts and Jobs Act, which was signed into law December of 2017, restricted many itemized deductions through tax year 2025. That includes the combined $10,000 limitation on state and local income taxes, property taxes, and general sales tax. The deduction amount of home mortgage interest is limited to the amount related to a principal balance of $750,000 or less for debt incurred after December 15th, 2017. A pro rata amount of mortgage interest paid on the year is deductible if the principal balance of the debt is greater than the limitation. Interest paid on a home equity line is only deductible if the debt was used to buy, build, or substantially improve the home that secures the loan. So oftentimes we'll see our clients make sure that they keep their mortgage balance under $750,000 if they're able. All right, and then itemized deductions, the 2% deduction worth kind of throwing out there. Also included in the Tax Cuts and Jobs Act is the elimination of miscellaneous deductions such as tax prep fees, brokerage fees, or investment expenses, and unreimbursed employee business expenses and estate planning. So those of y'all that have been doing taxes for a while or filing tax returns for a while can remember when you were able to deduct these items, and currently you cannot. All right, let's talk about charitable contributions. So the limitation for cash charitable donations to public charities is 60% of your adjusted gross income. So you can't give to charity and completely wipe out your income. Non-cash donations such as cars, art, or items you would donate to Goodwill, such as clothing, household items, furniture, etc., are limited to 50% of your AGI. Capital gain property, such as appreciated stock, is limited to 30% of your AGI. Donations to a donor advised fund or private foundation are deducted in the year in which the donation is made to the fund. You do not receive an additional charitable deduction when the money is transferred to a qualifying organization from the donor advised fund. Charitable donations that exceed the limitations are carried forward for up to 5 years. The IRS does have, this is kind of interesting, as virtual currency is a little bit more in the forefront these days. In their FAQs, the IRS has a thing about virtual currency transactions, and it addresses the charitable donation of cryptocurrency. An individual who donates cryptocurrency to a charitable organization will not recognize income gain or loss from the donation. If the individual held the cryptocurrency for more than a year, the amount of the charitable deduction is equal to the fair market value of the cryptocurrency at the time of the donation. So kind of similar to stock. If the individual held the cryptocurrency for less than a year, the amount of the charitable deduction is equal to the lesser of the basis in the cryptocurrency or the fair market value of the cryptocurrency at the time of donation. Because cryptocurrency is digital/virtual asset type, they're treated as property for income tax purposes. So such donation will be considered non-cash and will need to be reported on Form 8283. So let's talk about some charitable planning. So some planning items for maximizing your charitable deductions include alternating your donation years. So keep in mind, your benefit for taking itemized deductions is only the amount that exceeds your standard deduction. So if you alternate your donation years, you may be able to alternate taking itemized deductions in some years and the standard deduction in other years in order to maximize your charitable donation benefit. Donor advised funds are great if you have high income, a high income year in which you know you want to be charitable, but you haven't yet identified the charitable organizations you'd like to give to. You'll receive the deduction in the year you make the donation to the donor advised fund, and then you'll have subsequent years additional time to disperse the funds to your charity of choice. Qualified charitable donations from an IRA are a great way to reduce your taxable income while satisfying the required minimum distribution amount. You can do up to $100,000 per tax year from your IRA, and you must be at least 70 and a half years of age. So I really like this one because oftentimes I'll find that taxpayers that are taking the standard deduction because their itemized deductions aren't great enough, and they have required minimum distributions, and they're very charitable. So I like to encourage them to do this QCD, qualified charitable donation strategy, because they're able to give to the charity directly out of their IRA, and it reduces their taxable IRA distribution amount. And then finally, donating appreciated stock. So when you donate appreciated stock, you do not recognize the appreciation as taxable income, and you get a charitable deduction equal to the fair market value of the appreciated stock. So donating appreciated stock to a donor advised fund instead of donating cash is a great tax planning technique. Let's take a deeper dive into donor advised funds because we see this strategy a lot with our clients. Taxpayers can participate with a donor advised fund by opening an account with a sponsoring organization by making contributions to that account in the form of cash or stock. Once the funds are contributed to the account, the contributions are owned and controlled by the sponsoring organization. However, the taxpayer still retains advisory privileges over the account with respect to how the funds are invested, and both how and when distributions to charities are made. Donor advised funds also provide charitably minded taxpayers the opportunity to pre-fund their charitable giving to be executed in retirement years or to pre-fund charitable giving in tax years where they have higher income. To the extent a taxpayer is aware of higher income years, this becomes a great planning opportunity, and educating taxpayers on economic events triggering high income years can be an effective strategy with planning. Such examples, some taxpayers may be selling a business, selling real estate with a capital gain, or exercising stock options. Those are all great situations where donor advised funds should be considered. Donor advised funds are a great opportunity to provide charitable support to organizations when needed most in economic downturns without pressuring the cash flow of individual taxpayers, also subject to the same economic environment. In a sense, the charitable support is prepaid and available when a cause close to the taxpayer is in need. All right, I think we're up for a poll question.
Right, I'm going to go ahead and launch that polling question and remind everybody that you make sure you're answering the polling questions. In order to receive CPE credit, you will need to answer at least 80% of the polling questions. We do have the Q&A activated if people have questions. There is a short amount of time with a lot of information to give. So if for some reason we're not able to get to your question, it will be taken offline and get back to you. So I do want you to know that the Q&A is available now. With that, I'll hand it back to you guys and leave the polling question up for a couple of seconds for you all to answer, or a couple of minutes while they continue on.
Up next, we have investments. On the next slide, we've got the rates, the breakdown of the tax rate for capital gains by filing status. And they show you where the 0% rate is, the 15% rate, and the 20% rate. And these are based off of the adjusted gross income. One thing to think of when you're selling or figuring the tax is the net investment income tax, which is 3.8%. When your adjusted gross income exceeds 200,000 for single and head of household, 250,000 for married filing joint, and then half of that for married filing separate. Every year, I like to encourage clients to contact their broker to discuss their account and review its performance and ask some questions. And one of the big one is the projected capital gain distributions on the account from any mutual funds or exchange traded funds that they may own. Also on the next slide, we talk about capital gains and what you can carry forward from year to year. You can carry forward up to $3,000 a year for married filing joint and deduct that. In that phone call with your broker, I encourage clients to talk about any tax loss harvesting to offset any gains that they may have had during the year. Some of the gains they may have known about, some of the gains they may not, like those aforementioned capital gain distributions. It also gives you a good time to speak with the broker on adjusting the performances and the targets of your account. And then encourage clients to use 100% of the losses during the year. $3,000 a year with some losses that were generated can take a long time to receive the full tax benefit of it. So if we've got some gains we want to harvest to offset those losses, it gives you a chance to reset the account and reset the gain or the cost basis in the security. And by having the conversation with your CRI advisor too, is there a carry forward from prior year's losses? And do we have any gains with the broker? Is a way to go around to work on that. With like-kind exchanges, the sale of your primary principal residence is still $500,000. At the rate the value of primary residence has increased in the last few years, we will start to see more and more people reaching that number for a married filing joint. So I encourage you to meet with your CRI advisor to discuss what is the cost basis of the property and make sure everything is there. For years, the answer was always, no, you don't have a gain. But now we may see gains as price of houses continue to rise, especially where the firm's footprint is along waterways. So be mindful of that when you go forward. For 1031 like-kind exchanges, if you have property that you want to sell, it is always nice to consider those. And that's on the next slide. They're solely limited to real property, and it must be an investment or income producing property. There's the 45-day rule and the 180-day rule. And you need to use a qualified intermediary. These rules are fairly well set in stone, and if you violate them, you can sour the exchange for tax-free. One thing to consider with your advisor is doing the exchange worth it? There have been times where it was better for the client to realize the gain, and then by use of a cost segregation study, which CRI has many trained professionals that can do those, we were able to have a big capital gain, but then we took large ordinary losses because of that cost segregation study. And it worked out in the client's benefit to do that, reset the basis, do the cost seg study, and they were able to pay less in taxes that year because of that. And like I said, Carr, Riggs and Ingram has a number of people qualified to perform that. It's got to be a qualified person. Just because you're a builder doesn't mean the IRS considers you qualified to perform a cost segregation study. So please contact us with that question and we can get one of those studies prepared for you. One of the other things to consider with capital gains and when to show them, when to see them, is overall tax planning. The estate rules reset from 12.9 million in December of 2025, so January 1 of 2026. It falls down between 4 to 6 million. So there could be a time to take some capital gains now at 15 or 20% versus whatever the future may hold on those. Predicting what Congress will do will never win things over. Up next, we discuss energy credits. On the next slide, the vehicle credits, the federal government turned them on their head and shook them pretty hard this year. And the credit now is back to the most you can get is $7,500 for a new vehicle. The old rule of the first 200,000 EVs sold has been eliminated. So now Tesla and a number of other manufacturers are eligible for the credit. There are certain hoops you have to jump through to meet the requirement for the credit. Some of the biggest hoops deal with the AGI, adjusted gross income, and the price of the vehicle. It can't be more than $80,000 for van, sport utility vehicle, or pickup, and it can't cost more than $55,000 for all other vehicles. What is also new this year is used EVs are now eligible for the credit. The link on the website below is a federal government website that lists all of the vehicles that are used that qualify. And some of these vehicles go all the way back to I quickly scanned it. It's a 2011 Chevy Volt or Nissan Leaf. So when you're discussing a used vehicle purchased, it's a 30% of the cost up to $25,000, and it has to be purchased from a licensed dealer. And so there's a couple of hoops to jump through. You can't just go buy a car from somebody on the street and take the credit up to $4,000. But this is the first time a used vehicle has been given an energy credit. And just be mindful and tell your CRI advisor if you bought a car that is eligible. On the next slide, we've got the certain hoops you have to jump through to buy the vehicle to get the full credit. The dealer is going to be very good at telling you which one of the credits their vehicle applies for, because it has to have a certain percentage made in the North America. There's also a battery percentage and other things. And we have to rely on the manufacturer to give us that information. But what the dealer doesn't know, the salesperson does not know, is what your adjusted gross income is. And there's a good chance if you can afford an $80,000 SUV, you may be over the adjusted gross income of $300,000. So I have seen in years past when the energy credits first came out that the salesperson told me I qualified, and you didn't give the salesperson your AGI, thankfully, but you didn't qualify. So be mindful of that when you go to purchase the electric vehicle. Does it meet all the requirements, and do I qualify for this because of this? And there's ways to, hey, if there's big capital gains that bring your adjusted gross income up, can we sell anything at a loss? So that is the matrix for the full $7,500 credit. When they passed the energy tax laws that brought in the vehicles, they also did the standard windows, HVAC, and other things. And this is no longer a lifetime credit, but is an annual credit. and that's on the next slide. The max for this is $1,200 a year. The HVAC, biomass stove, boiler, and similar things get a separate credit of up to $2,000 a year. So it's a total of $3,200. Things to think of, since this is now an annual, windows, including skylights, the new is 30% of the cost up to $600, excuse me. And everything in here has a cap. The right-hand side of the column is the current. The left-hand side is the prior years, just to show what it went from 10% up to 30. And like I said, it's a $1,200 a year credit that is just for that year. The old rule, it was a lifetime maximum. And so if you did 3 windows, you met your maximum, you couldn't do them anymore. You didn't get the credit. Now it's annual, up to $600 a year for windows, up to 30% of the cost. Once again, we take the manufacturers to make sure that their window meets the specifications of that. The other thing to also consider when you're doing like a battery storage system or something else, you have to have taxable income. These are non-refundable credits. You will not get 30% of the solar system that you put on top of your house and paid $100 grand for unless you have that much in taxable income. Once again, the salespeople do a great job of telling you all this money you'll get back, but they do not know what your tax consequences are. So a number of times we are the bearer of bad news with that no, you don't have the credits to get the full amount. And some of them carry forward, some of them do not. It just kind of depends. We are now at our next polling question.
Righty. I'm going to go ahead and launch that polling question and probably be aggravating and remind you guys again to make sure that you're answering the polling questions in order to get CPE credit. At least 80% need to be answered. I'm going to go ahead and leave it up for probably about 2 minutes so you guys can make sure that you're answering and getting your CPE credit, and I'll hand things back to Tom.
All right, I am up next, family and education tax credits. All right, let's first talk about the child tax credit and dependent credit. So for 2023, families claiming the child tax credit may receive up to $2,000 per qualifying child under the age of 17 at the end of 2023. The maximum amount of the credit that is refundable is $1,600 per qualifying child, even if no tax is owed. You must have earned income of at least $2,500 to take advantage of the credit's refundability. The credit phases out for taxpayers with adjusted gross incomes above $400,000 for married filing joint returns and $200,000 for all other returns. You may be able to claim a credit for expenses such as daycare, nursery school, before and after school care, and summer camps if you paid such expenses for the care of a qualifying individual under age 13 to enable you and your spouse, if filing a joint return, to work or actively look for work. The allowable amount of the dependent care credit ranges between 20% and 35% of the eligible employment-related expenses incurred by the taxpayer in 2023. $3,000 if there is one qualifying individual with respect to the taxpayer for such tax year, or $6,000 if there are 2 or more qualifying individuals with respect to the taxpayer for such tax year. So I always like to tell taxpayers that, even after school care, I think a lot of people think, before your child reaches, kindergarten, oh, you have daycare costs, but really for school age kids who are going to after school care programs or before school care programs or day camps in the summer, I do want to note that sleepaway camps do not count toward this credit. All right, let's talk about flexible spending accounts and health savings accounts. So a healthcare flex spending account, or FSA, is a special account you put pre-tax dollars into, and it can be used for certain out-of-pocket healthcare costs. These are typically a use it or lose it type of account, meaning you must use the money in the FSA within the plan year. Some accounts may provide a grace period for up to 2.5 extra months to use the money, or the ability to carry over up to $570 per year, or 20% of the maximum annual contribution amount to use in the following year. For tax year 2023, the contribution limit per person is $3,050. Now let's talk about the health savings accounts, or HSAs. This is a type of account that lets you set aside money on a pre-tax basis to pay for qualified medical expenses. To be eligible to contribute to an HSA, you must have a high deductible health plan, have no other health insurance coverage, not be enrolled in Medicare, and not a dependent of another person on their tax return. These are not use it or lose it types of accounts, and the funds do not need to be held in cash. So the funds can be invested and grow tax-free as long as withdrawals are used for qualified medical expenses. The tax year 2023 contribution limit is $3,850 for a self-only plan, and doubles to $7,750 for a family plan. If you're age 55 and older, an additional $1,000 catch-up contribution can be made for either self-only or family plans. You have until April 15th of the following year to contribute to your HSA. If you make non-qualifying distributions from an HSA, that distribution is subject to income tax and a 20% additional tax. Distributions are not required from HSAs, so the money can stay in the account and continue to grow. I want to briefly touch on how HSAs can be used in retirement planning. Your HSA contribution each year reduces your taxable income today. Then these funds grow tax-free. Healthcare will likely be one of your top 5 expenses in retirement, so HSAs are a great way to save up for these expenses. You can tap into your HSA account in retirement to help cover your health insurance premiums if you retire before you're eligible for Medicare. Can also help cover Medicare premiums in retirement and pay for part of your long-term care and premiums. So great tax savings tool, or tax effective savings tool. All right, let's talk about college funding. So these are some college funding mechanisms. We have an education savings account, or ESA. This can include elementary and secondary education. The contribution limit is $2,000 per beneficiary, and whether or not you can contribute to an ESA has income limits. We honestly don't see this a whole lot. It just doesn't apply to a lot of the taxpayers we see, but I did want to throw it out there because that is a college funding mechanism. Then there's the qualified tuition plans, or also known as 529 plans. I think everyone's pretty familiar with these. Anyone can contribute to these accounts no matter their income. Contributions can be made up to 5 times the annual gift tax exclusion and elected to be spread over 5 years. So for 2023, this amount is $85,000 for an individual and $170,000 for gift splits. No gift tax consequences are incurred with this strategy. It's a great planning tool in the year of a major income event, such as the sale of a business. Over 30 states offer annual state income tax deductions or state tax credits for 529 plan contributions. This benefit can vary per state. All states allow for a $10,000 per year per kid withdrawal from a 529 plan for K through 12 private education. However, some states consider this a non-qualified distribution and may subject the withdrawal to state income tax and even impose a penalty on the earnings portion of the distribution. So you definitely want to check with your CRI advisor on the rules of your state specifically. And then some people withdraw funds from an IRA to pay for college. So there's no early withdrawal penalty if utilized for the taxpayer, spouse, children, stepchildren, or grandchildren's education. And this can be potentially tax-free distribution when the funds are withdrawn from a Roth IRA. Let's talk about a couple of education tax credits. So here's a comparison of the American Opportunity Tax Credit and the Lifetime Learning Credit. I like to think of the first 4 years of college are given the opportunity. So that's why I always go to when I'm thinking, okay, which credit? That American Opportunity Tax Credit, that's your first 4 years of college. The Lifetime Learning Credit applies to education after the first 4 years of college. These credits phase out when modified adjusted gross income is $160,000 to $180,000 for married filing joint taxpayers and $80,000 to $90,000 for all other filing statuses. Most of the taxpayers I see don't benefit from these credits, but they certainly can in maybe a year where income is down. Most of the time when it comes to the college funding, people are kind of stockpiling in a 529 plan and then pulling the funds from there to pay for college. All right, I think we're up to our next polling question.
All right, let me go ahead and launch the polling question. And again, just a reminder, I'm going to remind y'all every single one, make sure y'all are answering these in order to get your CP credit. And I'll leave this up for another minute and a half, 2 minutes, so that we can make sure everybody gets their own votes in. And I'll go ahead and hand this back off to Stephanie and Tom.
Up next, we have retirement accounts. In the last 2-3 years, the federal government has made us relearn all we knew about retirement accounts. On the next slide, the most recent one is the Secure Act 2.0. And that was for 2023. It increased the RMD age to 73. It also decreased the penalties if you missed your RMD for the year. And Tina, if you could advance to the next slide. If you missed an RMD, the penalty is now 25%, down from 50%, and it gave you an option to reduce it to 10%. In the future, in the next 2 years, there's going to be some additional opportunities for 401ks and 403bs that have automatic enrollment for all new plans. Currently, you have to elect in to the retirement system when you become hired. Going forward, if it's a new plan, you will be automatically enrolled and you will have to elect out of the retirement plan. This is to encourage savings and to encourage people to participate in the retirement plans. And also starting in 2024, there's a 529 to Roth rollover provision that allows you to move any unspent 529 plan funds into a Roth. Daniel Rodriguez with CRI TPA Services did an It Figures webcast earlier this year on a number of some of these changes that Secure Act 2.0 did. I highly encourage you to go to the website and to watch that, as well as reach out to your CRI advisors to see which one of some of these future provisions makes sense for you and you're eligible to work on. On the next page, we've got the limits for this year and next year, what can be contributed, and those get adjusted annually, or they historically have been adjusted annually for the last good while. They're not tied to inflation, but they do go up. And on the next slide, we have strategies with different IRAs and what to do. The biggest thing on these is to make sure that you've contacted your advisor to see what you're eligible for. If you make a IRA contribution in January and then you find out later you earned, or you make a Roth contribution and you find out you earned too much, to go back and do it another way can be challenging, and it can generate some tax consequences. If it was done at one time with the broker and the CPA working together, it can solve and satisfy some of those. So I encourage you to contact your CRI advisor and make sure that you're making the correct contribution. Also, is it to the correct type of account? Are the taxes saved or paid today worth the taxes saved or paid in the future? Is Roth better than a regular, or is regular better than Roth? Everyone is different. Every person and age and qualifications are different. So to lump people into a bucket and say, no, if you're over X or under Y, you should be in this or that, is a somewhat of a misconception. It's is the taxes saved today or paid today worth what you would or should pay later? On the next slide, we have the limits for contributions to the IRA and when and where the income limits for that. And once again, make sure you've been in contact with your advisor to see which ones you can make, which ones you can't. And when you're contacting your broker, to make sure they have the correct information in for you. On an earlier slide, the penalty for not making an RMD is 25%. That's substantial now with some of the RMDs we're seeing out of clients. And when you talk to your broker, ensure that they've got the correct age so that the RMDs are starting correctly. They don't start till 73. They used to be 70 and a half. And so a lot of people in these last 3 years have been somewhat in limbo and not receiving them. Like I said, the age, make sure the beneficiaries are correct. If it's possible to combine these into one account, it may simplify things, or into as minimal number of accounts. The RMD rules are not for every account you have. It is for all of your retirement accounts in total. So it may be better to take a lot out of one and leave the other one. And once again, the broker, if they're all with the same broker, the same trusted advisor, they can help you with that better than if it's with a bunch of different ones. And so meeting with a CRI advisor to get all of that under one roof per se, and an understanding of what all you have and what all you're dealing with, will help you with maximizing the return and minimizing any possibility for penalties or errors in the future. Up next, we have some foreign considerations.
All right, I'm just going to briefly touch on foreign considerations. Not a huge expert in this area, but I do see, we do like to ask our clients this question, and any taxpayers that we're advising about any foreign financial accounts held. So if you hold any financial interest in or signature authority over a foreign financial account exceeding $10,000 at any time during the 2023 calendar year, you must file a report of foreign bank and financial accounts, or FBAR, with the Department of Treasury. The report must be filed electronically. The due date for the 2023 FBAR is the same as the tax filing deadline for Form 1040, so April 15th, with an automatic 6-month extension to October 15th. All right, let's discuss some gift considerations. Oh, poll question.
Okay, it looks like you have a poll question right before then. All right, final reminder on this is your last polling question. And on this one, I'm going to jump in because the answer to this, if it's no, y'all should go ahead and get on that social media for CRI CPA and make sure you do that. But with that, I'll leave this one up again for another 1.5 to 2 minutes and hand it back over to Stephanie.
Thank you, Tina. All right, some gift considerations. So what is considered a gift? This is any transfer to an individual, either directly or indirectly, where full consideration, measured in money or money's worth, is not received in return. What can be excluded from gifts? So there's a few things that don't count as a gift in the IRS's eyes. Gifts that are not more than the annual exclusion for the calendar year. So for 2023, that is $17,000. goes up to $18,000 for 2024. Tuition or medical expenses you pay for someone, gifts to your spouse, gifts to a political organization for its use. So as I mentioned, the annual exclusion per donee is $17,000 for 2023. Many taxpayers think they're taxed on gifts they give to others, or that the recipient will be taxed on receiving the gift. That is not the case. As long as the gift is under the annual gift limit, no gift tax return filing is required. If the taxpayer gives more than $17,000 to an individual, a gift tax return must be filed. However, what a gift tax return does is it simply reports that the taxpayer ate into his or her lifetime gift and estate tax exemption, which is currently set at $12.92 million. Married couples can gift split, so they can each give $34,000 per person per year without needing to file a gift tax return. So the lifetime exclusion for donor, that is $12.92 million for tax year 2023. This is doubled for married couples. This current provision is set to sunset at the end of 2025. So as of January 1, 2026, the exemption is expected to be in the mid to high $6 million range, unless Congress makes these changes permanent. The big question is, if the higher exemption disappears after 2025, how do you take advantage of it before then? There are several strategies to lock in the $12.92 million exemption. For the majority of people, the gift and estate tax exemption will allow for the tax-free transfer of wealth from one generation to the next. For those who have acquired enough wealth to surpass the gift and estate tax exemption, there are several strategies that could lock in the $12.92 million exemption. The simplest way is to gift your assets to loved ones now, rather than waiting until you pass away. If you have the means, giving the assets now has two advantages. First, you get to see your loved ones benefit from your gifts. Second, the gifted assets could increase in value for your loved ones and could decrease your taxable estate. For example, if you were to give the entire $12.92 million to your children today, that money could grow over time and your loved ones will have received the entire amount free of gift and estate taxes. On the other hand, if you held on to those assets and you passed away in 10 years, a large portion of the accumulated wealth could be taxed 40%, leaving your heirs with much less. One concern many people have when it comes to giving assets away early is that sometimes the person receiving the gift may not be ready to handle the responsibility of managing such a large amount of money. A good example of this is a large amount of money gifted to a young child or a teenager. One way to give those assets, but ensure they're protected from misuse, would be to give them to an irrevocable trust and make the child or teenager the beneficiary. So we see this often, and it's kind of cool how trusts work because every trust document's different. So you can put money in a trust, get it out of your estate, deem a beneficiary, say one of your children, and you can say in that trust document, they can only take money from this trust for education, or they can only take money from this trust for medical care, or a combination of the two, or maybe they have to prove to the trustee that they're holding a full-time job if they are to take any distribution. So it's kind of interesting how those stipulations can be tailored today to how you want your money and your legacy handled even after you're gone. And that is all I have today. We appreciate everyone coming in. Have we done well, Tina? Are we good on time?
You are right to the minute on time.
And I see we have a lot of questions, guys. I promise you we'll get to those questions and get those answered once we wrap up.
All right, then. Hope everybody has a great day and hope to see y'all on our next CPE. Thank you, guys.
Thank you, guys.
Thank you.